Okay, I was just about to give a warm welcome to Sadia, only to be told that she has not been able to make it. So I'll give a warm welcome to Diane instead. I wanted to say just a couple of words about the World Bank work in this area to sort of set the scene for the discussion of the panel. That when we set out to measure comprehensive wealth at the bank, we could measure produced capital and commercial natural resources. We didn't have numbers on human capital, so we knew we were missing something big. So in the first book, we sat down and took Marty's approach. They said, well, why don't we measure wealth as the present value of future consumption? And you have to make assumptions about the future to do that, but we did it. What comes out the other end is that since you're only measuring produced and natural capital, the difference between that and the present value of consumption, forecast into the future, is about 80%. Right? It's huge. It's an enormous number. Now, work done subsequently in the Oxford volume, we could say that probably 3/4 of that is human capital. So we're still left with about 20% of unexplained capital that is not physical. It's not something you can drop on your foot. And so there is an agenda here. It's a missing stock, it's a missing asset. So it's probably some accumulation of changes that we've seen in efficiency in producing things that we can consume. And so TFP is probably there. Institutional quality is probably there. But here's where we're turning to the panel to give their wisdom. What's in there that we're not measuring, that's almost certainly intangible? And we'll start with Rick, yes.
Okay, this is a bit unusual, but there we go. Thank you very much. I think it's probably useful to start with thinking how Kirk and the World Bank actually calculated this. I mean, basically, you take the present value of consumption over a 25-year period, that's your total wealth. Then they look at what they can measure, so they look at physical capital, they do their utmost best to calculate natural capital, and nowadays they look at human capital, and then the residual is basically the sum of what we do not know. So I think intangible capital is basically everything you don't know. In that sense, it's basically very similar to the solar residual. So where you also have that, for example, in a production function that you're looking at growth, you try to account for the changes in growth, trying to kind of account it, to ascribe it to either capital, to labor, or to resources or whatever. And then the bit you don't know is the solar residual. So this is exactly the same as that. So it really is a measure, and there's no reason at all why this intangible capital, thus measured, should be positive. Indeed, countries can be so clumsy that if you add up all their capital, their oil, their natural capital, their infrastructure, their physical capital, and all kinds of other capital, and that it's not enough, that it's more than the present discounted value of consumption. So, so that means that's presumably for basket case countries. And these are typically countries like the Congo, for example. I remember they're typically failed states. So typically states where you see it as which have been in perpetual kind of war, often conflict about natural resources. These are states which are typically have rent seeking is too modest a term to describe what's going on there. They've been basically stealing anything they get out of the ground. And then, so basically, a part of this intangible capital, in the worst possible case, it's wars, it's corruption, it's stealing, it's the worst possible thing you can possibly imagine. So there's a whole lot of that. But of course, it's also things like, if Jeff Sachs would be here, he'd probably argue like geography. I mean, like a country like the Netherlands is pretty stupid at most things, but it's lucky that it's at the end of a big river, and it's the hinterland for Europe, and then it can transport all the stuff all over the world via the sea. They still have to keep on pumping, don't we all? But other countries which are more landlocked may be less lucky, and they may have less access to main ports, and in that sense, the way they combine their factors of production and they combine the different types of wealth, it doesn't add much to it. So that's another thing, the geography, quality, the wars, corruption, but also, bluntly speaking, the quality of institutions. Well, I mean, that's of course the thing the World Bank has been hammering in for years and years, but it's basically also, if you look at it, it's basically also something we don't really know. You see something pretty terrible happening and we get these data we don't really know, and they're also very terribly endogenous. It's also things like how effective are your property rights? How quick is it to set up a company? It's pretty quick to set it up in England relatively to what you see in Russia, for example, at the moment, and particularly what you see in many African states. So the amount of red tape is also presumably not particularly boosting the intangible capital. It's also the case that we find that if we look across poor and rich countries, that it is particularly rich countries who seem to have a larger proportion of intangible capital. Last estimates I saw, I think they were from the World Bank, was 80% for the rich countries and 60% for the poor countries. Or whatever it is, it means to say that rich countries, like for the solar residual that's true as well, are better able to combine their existing forms of capital to produce a greater stream of future consumption. So that's what we see as well. Now, what's very important as well, and I believe Kirk himself was working on that, is the thinking of bowling alone. David Putnam, thinking of the guys, the stuff like people like Steve Durlaff are doing, Marcel Fachan, and all you lot people as well, this whole business of trust and social capital. And we know that if there is more trust, there's more transactions going on, it's easier to trade, and then presumably combining your existing forms of capital will lead to a bigger present discounted value stream of future consumption. Some people would argue, I don't know much of the evidence for this, not my expertise, but that having stable families and things like that might also be part of intangible capital. Emancipation, health, the fact you could of course zoom into that intangible capital and then try to have something called health capital. I'm not sure whether that's going to work very well, but something like that could be done. Well, then finally, and I should probably give the word to other people, I mean, there is the bit of education. There was an intangible, and people are now making an effort to make that tangible. But that leaves, of course, there is still this whole idea of learning by doing, ideas, things we can't really capture in a market. I mean, you could also, of course, you could try to value trademarks, patents, goodwills, copyrights, intellectual property rights, but there's still a lot of stuff that you can't patent or which you can't put a price on, and then it will be intangible. So you could try to get that thing from 80 to 60% down to 30, 40, 20% and try to get it better. Jonathan Haskell and his colleagues have been doing hard work, I think, on public intangibles. And it would be useful to actually zoom in on that as well. Of course, Mariana, you talked about it as well in terms of the public state. But so some people have done more work on it. There's a Dutch guy who has done a lot of work on this Groningen project. It's called Bas van Ark. And he's now in New York. And they're also doing work on these intangibles. So I think it's important, but it's still, basically we're still doing accounting, and I think we can probably zoom in a bit better on that. So I'll leave it at this as an introduction.
Good, thank you. Diane.
I only learnt that I was doing this about half an hour ago, so I've got a slightly disjointed list of questions, really. Intangible capital is clearly very important, but it's also really fragile. And the obvious example is that if you look at a company, listed company, whose balance sheet value is largely intangible, it's goodwill, it's the brands and so on, can evaporate overnight. And that's going to be, I think, a very difficult question if we're trying to value different kinds of intangible capital. What do we do about that sort of fragility? Oh, and how widespread is it? And I think it's quite widespread with different kinds of intangible capital. So to take my second example, databases. They can get corrupted very easily. They can get hacked very easily. They too can lose their value very quickly. But the other point of that example is that there's so much of this that we don't have any statistics about. We don't know how many databases there are, how big they are, never mind how to value them or how to take account of the fact that value is potentially quite volatile. So lots of just basic data collection issues and classification issues. Which kinds matter? What ought we to include in intangible capital? I mean, we just had a really long list of things, and I think some of that will always be residual. We'll never get to the bottom of all of that. But just thinking through a classification system and which ones could we get some statistics for, and where are the boundaries between them, what goes into human capital and what goes into organisational capital, because it's about management techniques that can be imitated by one firm relatively easily if they know about them, or teaching techniques that can be shared. A third point is just about the public good character of the stock of knowledge and the many spillovers that there are there. So I raised this point this morning as well, that makes the valuation questions that much more difficult. And then the final point is what's the relationship between intangible capital and tangible capital? And the fantastic example is Crossrail, the tunnel that's being built through central London to put a new fast train line through. And it's a tunnel, so it's a civil engineering project of large scale. The only reason they can build it through Tottenham Court Road Station, which has a very complex network of tunnels and cables already, is that they now have the databases and the data transmission to be able to tunnel through the gap with about 20 centimetres of tolerance on each side. And what's more, as they spray the concrete on Crossrail, they are spraying sensors in it so that when the trains are running, they can feed back that information in real time to the control centre and be alerted to problems, fix problems much faster. So there's something about the relationship between intangible capital and tangible capital that I think we just don't understand very well. And that's a very concrete example, if you forgive the pun. So that's very short. My excuse is that I didn't have very long. And I'm going to hand over to Mariana.
So I'll pick up on Diane. Oh, God. Is that your microphone or mine? Am I being louder than you were? No? Anyway, so in terms of this relationship between tangible and intangible, I think it's actually interesting to use then the word systemic capital and also relationship capital, right? Because in fact, often we hear that the intangible capital is in fact about human capital, relationship capital, strategic capital in terms of also business models. But I kind of want to focus on these characteristics of the relationships, especially again thinking about some of the stuff around innovation, right? So we often hear that innovation is not just about R&D, but also things that are more intangible like design, et cetera. And I want to sort of focus on the systemic capital and relationship capital as a way to think of it. First, if you think again of some of the big changes that have occurred in the last century, mass production was a huge revolution in terms of production, distribution, et cetera. But it actually would not have had the effect that it did without this very strong systemic property, which actually came from, if you want, demand pull policies, including things like suburbanization. So Carlota Perez writes a lot about this, that suburbanization ended up being a direction for mass production. Or even, if you want, procurement policies that do or do not exist. I think that we should actually include them when we think about intangible capital, because these are sort of policies, you can't touch them. They actually then affect the degree to which these tangible capitals, this is actually a new sort of organization of production, actually end up having an effect on growth. And there's some very interesting examples on that, when they do and when they do not exist, and then their ability to allow tangible, like new factories, new organizational systems to actually have an effect. The other is this word I mentioned on mission-oriented investments, and David Mowery in the US has done a lot on that. I've always found it interesting when companies actually leave countries, then what they say on why they left. And recently, I think it was last year, or 2 years ago, General Electric and Vestas both left the UK, closing down particular projects. And when they were asked why, they said there's no vision, there's no green vision in this country. And actually there was lots of green policies, but what they meant by no green vision, if you actually look at then some of the examples they brought up, it was actually about a lack of systemic properties to the different sort of policies, this kind of patchy kind of policies that come and go. And again, that kind of systemic, cohesive nature of different policies, which then create that kind of certainty for businesses to then engage with, say, a green agenda, I think is, again, if you want, an intangible part of a system, which has a huge effect then on the sort of tangible investments that are made. On the relationship capital, with IPR, which I mentioned quickly before, it's interesting how, again, the work of people like Dick Nelson at Columbia and his co-author Roberto Mazzoleni, you know, if you again think of patents and all the work on IPR and just come back to the word that it's, again, a contract, it's not a right, then the intangible sort of capital should, especially if we think of, you know, the human capital, the relationship capital words that are often out there, on what actually is then the relationship between these two, if you want, bargaining, negotiating sides. So Dick Nelson's work has shown how patents, in order to really nurture productive entrepreneurship and not what Baumol calls unproductive entrepreneurship, should actually be weak and narrow. We should have weak and narrow patents. Instead, we end up having very strong and broad patents. But that's not coming down as, you know, manna from heaven. These are negotiated. And so the ability for two different sides to negotiate something like that, again, should enter our discussion of intangible capital, I think. By the way, the Bayh-Dole Act, which was so important to allow publicly financed research to be patented, which was done in order to facilitate commercialization. There's a deal in that contract, in that legislation, which is called the Bayh-Dole Act in 1980. It says when you have publicly financed innovation, then the public should be able to negotiate the prices. You know, marching rights on things like the drugs, right? Never exercised. Why it wasn't an exercise? Because, again, of this kind of this very skewed negotiating power, or power relationships. So again, power relationships and how to discuss them openly should be, again, part of the intangible. Lastly, this whole word ecosystem, I always kind of get not nauseous, but tense when I hear it, because ecosystems can be predator-prey, mutualistic, you know, parasitic, etc. And we can learn a lot from biology about how not to set up predator-prey ecosystems, or at least how to identify them. And so again, if you think of the word design as having been very important to the way that people talk about the role of intangible capital, again, not just R&D, but design concepts, fine. But then take, again, that iPhone example where really important design concepts were done, but on the back of tangible, if you want, technologies that were put together in cool ways, which were absolutely essential to, you know, things like the iPhone and everything else. But that, you know, to avoid those kind of free-riding relationships and to make sure that they're mutualistic, or also space with low Earth orbit, right? You have all these new actors now in space, from Elon Musk to Richard Branson. Those relationships should be cured and negotiated. So when the example I gave in that Lunch with the FT article, I said, you know, when Justin Bieber goes up to space and spends 30 million, and unfortunately comes back, 30 million, and all that money goes to SpaceX, and yet it's on the back of this public infrastructure, and yes, space tourism as a new concept. You know, that's a problematic relationship. That's not a symbiotic relationship, because the future missions, whether it's Mars or whatever, aren't getting, you know, aren't part, if you want, of that more wholesome, cohesive, symbiotic system that we could be setting up. But that's all about power, negotiating, and these are about contracts.
Okay, we are in the rare situation of having a lot of time now to discuss. Now, this either means that there isn't much to say on this topic, or people feel like they don't know much about the topic, or maybe Marty's going to solve our problem for us.
Very hard to define them a priori, because the human footprint is so ubiquitous that you can't go back to a pre-human day. Let me give you an example. There's lots and lots of examples of this. The tallgrass prairie in the United States has what was the tallgrass prairie, has the richest soil in the world, along with Chornism, Ukraine, Russia, and the Pampas in Argentina. They all have the same soil. So basically, what was going on here was that instead of trees growing or forests growing, there was this tall grass prairie whose roots went down 2-3 meters or so. And nobody could break this sod until there was steel moldboard plows, and people were suspicious. The early settlers were suspicious that because this didn't promote growth in trees, there must be something wrong with it. Okay, so now, once it was discovered how to plow out this prairie and what rich black soil of many meters was below it, it was torn up from end to end so that the only thing that remains is cemeteries or right-of-ways of railroads. Now, then began a process that, over my lifetime, where we more and more zeroed in on what was the cause. So here was a tremendous ecosystem that was destroyed. But what made that ecosystem? What made that ecosystem is not a climax system, because if you leave it alone, trees will come in. What made it was fire, and the fire was man-made. The fire was that the Indians would burn this systematically for a variety of reasons, to have fresh new growth and so forth. So now, what is it we're preserving or going back to? The original state was a man-made, the original nature was actually man-made. There are actually a lot of examples of this sort of thing, so I think we need broader principles. I think what we're trying to do really is to preserve historical examples of things. And the distinction between man-made or man-interfered with, it doesn't hold up. The species of birds that we have out there are a function of how much farmland there is, and so forth and so on.
Yes, we didn't. We clearly didn't exhaust the previous topic. Go back to Owen and then Cameron.
Yeah, and they were brought to the United States.
Okay. So I just kind of a question for Kirk, right? So in your approach, it's kind of top down. You estimate the wealth and then you kind of distribute it between the assets, right? But then the other approach is like the UNDP or the Arrow approach, and they go from the bottom. But when both of you do it, you get like really high intangible capital, but the other guys get really high share for human capital, right? So is human capital the biggest driver of this, or what's your opinion on that?
Well, empirically, as I say, what's coming up is that in rich countries, about 60% of the total wealth of the country, building from the bottom up, is human capital, right? So there's a central tendency in the numbers that we're starting to see on human capital. So that's reasonably firmly established. And all I was pointing out is that if you also take, Marty seriously and bravely forecast consumption into the future, there still seems to be something left over, and the panel, chipped away at the things that could be in there. So that's my view on it. There still are probably important things like institutional quality hiding in there, and in developing countries, this is a huge part of the story, clearly. Cameron.
So a question in a similar vein. If we start from the facts that intangible wealth seems to be a reasonably big proportion of the total, kind of factoid 1. Factoid 2 is that we don't really know what's in it very much or very well yet, and we are struggling to estimate it. Do you put those two things together and say, well, this is really potentially quite undermining to the robustness of wealth estimates, and hence to the prospects of such estimates being routinely, incredibly, and robustly used in policy making? And I guess I'm throwing that challenge out there. I can think of a couple of responses myself, but I'd like to hear what you and the panel and others in the room think. Is this critical to wealth, or are there ways around it?
I'm not sure this should turn into a let's ask Kirk a bunch of questions session. I'm happy to jump in, and I will before we finish up. But I do want to cast the net wider. And we are finished with the previous session, I hope.
Yeah, and we are, because I can't resist it. Of course, there's no ex-human environments out there, but nothing follows from that I can see. On the substantive point that Cameron raises, I I mean, it really does have policy resonance, because supposing what we're doing here is discovering the depth of our ignorance about what the true wealth position is. Okay? Do we conclude from that that we should nevertheless use our very partial estimates and decide public policy on the basis of that, our views about inequality and wealth, the numbers we've seen? Or do we say, given that degree of ignorance, actually most of the propositions that are made on the database we currently have are probably going to be wrong? And that's a question about the aggregate, but it's also a question of the direction of travel. So there's quite a lot in the existing data which tells you about the direction of travel in respect of those assets, and that in itself is important. So let's take some non-tangibles, like, say, the electricity system. We know a great deal about the valuation of that. We know about whether capital maintenance is taking place, etc., and we can make judgments and choices about that. We know also in inequality terms quite a lot about what wealth individuals hold, and if the policy question is, how do we want to change the distribution of income, then we can work with what we've got. But on these broader questions, the answers may be very different. And so I think it's trying to be a little bit more unambitious, a little bit more cautious, a little bit more modest about what the questions are we're trying to answer, as well as being aware of the research agenda that's out in front of us.
Can I make a comment?
Of course. Please.
Oh, sorry. I'm just wondering if there's a parallel also to how you were talking before about natural capital, and in terms of actually paying, getting companies or whatever organizations that destroy it then to pay, if you want, for the cost. The parallel with human capital. So human capital, in its different dimensions, is a key form of, if you want, intangible capital in terms of also what nurtures it. If we then have certain types of business models, and there's lots of people arguing this, like an increasingly financialized shareholder value kind of, John Kay's argument, Andy Haldane, Bill Lazonic, etc., which then, for various reasons, is destroying that human capital, at least as it's private sector generated, right? Because human capital is endogenous. It's a result of investments that are actually made. Then that's where a potential sort of relationship is, right?
There may be a distinction here, which is that, and Colin Mayer will probably pursue this further tomorrow, since he's the person who's thought most about this in doing templates for how companies should do natural capital accounts. But a hell of a lot of natural capital, I was almost going to say all, but I want to be a bit careful because of oceans and so on, is owned by someone. So once you have an asset that's owned by someone, responsibilities come with it. So if you own a factory that's full of asbestos, you've got a liability on your balance sheet and you have to confront that. If you've got some natural environment within the assets that your company controls and you trash them, there's a consequence that flows with that. Okay? And there's a question about, on a balance sheet, reporting whether those assets are declining or increasing. You have to do that in the frame. So you need a risk register, just like you need a risk register for all these other things that you've mentioned too. Companies have risk registers, and then they have legal obligations. Now, the form of the law is really about the form of property rights, obligations and responsibilities for those who control assets. And some of those are going to be the state, because these have public good characteristics. But take the Amazon as a good example. Who's responsible? Who should be held to account for damage done to the Amazon? Right? Is it the people felling the trees, or is the pollution right the other way around? So I think that institutional structure is part of the framework, but it's in the nature of ownership that assets and liabilities, responsibilities get defined. Now, you might want to do that for human capital and others. If you damage your workers, if you damage their health, these are liabilities you confront. And that internalisation is part of the process by which the incentive issue that Cameron raised earlier starts to get addressed.
Rick. Rick had his hand up first. And Diane.
Well, I'm just a bit puzzled with all this doing things in stocks. So I'm terribly married to the kind of old-fashioned production function. And the reason is because I can ask many more questions. So, for example, if I have intangible capital, I might think that certain inventions or certain ways of doing things may improve the substitutability between different factors of production. And then I can see how that fits into the production function. Or I can think of certain things are capital saving, others are labor saving, others are energy saving. Rather than being just a total factor productivity, I can see there may be certain forms of intangible capital which lead to direct technical change, in the Acemoglu sense of the word. Then once I know that, I could try to get data on that, and I need to know how to price it. And then I can back out my capital, and I feel that step is perhaps more difficult than we think it is. It's easy it's relatively easy for labor, low-skilled labor, high-skilled labor. It's relatively easy for different types of capital, but for intangible capital, definitely there are no markets. How are you going to price it? Well, we can make up something, but to a large extent, I think we'll have to go back to the production function before we can get to this wealth accounting. And I see problems there. Anyway, that's not very helpful, that's not the way I think about it.
Diane?
I was going to come back to the wider question, and although I'm all for being modest and pragmatic about these things, actually I think the policy demand for answers to this kind of question is strong because of digital, not because of natural capital. And if you think about business models and the way they are changing, the business economists talk about ecosystems, and that's because that linear traditional model is switching to platform versions where instead of the value being captured by one company, which shares it among its shareholders and its workers and its managers, part of the value in the system is now outside the platform itself. So understanding, there are pressing policy questions that come with that, like competition policy, workers' rights and protections. So I think we're going to have to go on several tracks at the same time and do all of those things together.
But some of these digital forms of intangible capital are not being priced very well. For example, if you blah cars, you grab a hitchhike. I had to do it during a strike in France. I drove 300 kilometers from Montpellier down to the Spanish border for €9, and then 20% goes to blah cars. It's basically something like what do you call it again, Uber cars, or this Airbnb, or like Deliveroo in London. So as soon as it becomes a company, it's priced.
You value the bit in the company. We don't have such good valuation of the bits outside the company.
Yeah, that's true.
Against consumers. And in competition policy, the argument the companies would make is, well, okay, we're dominant in this market, but if you do anything about it, look at all the consumer value that you lose.
Exactly.
You have to be able to estimate that.
Exactly.
Willem wants to jump in.
Thank you. The sort of capital that the efficiency of management of assets clearly depends on, I think, property rights being defined and enforced properly at whatever level. And there are huge gaps there. I thought you underestimated when you said it's only water. I think the atmosphere is another example of a capital that is sort of rival, right? So not public good, but no property rights. I think the real problem is, though, in those forms of intangible capital that are sort of ex ante costly to produce and ex post pure public goods, at least in the sense of being non-rivaled, maybe excludable. And knowledge is the obvious example. Again, I have said this before, but the knowledge in the production function, right, or in the wealth accounts, in the residual, so to speak, is not IP, right? That's just a subset of it, patents, whatever else, right? 1 + 1 = 2 is incredibly useful, right? And everything rests on it, and it's free good. We have to really, I think, but the management of that stuff, of new knowledge creation, is clearly one area where the state's role has to be central, because we have to rely on these temporary monopolies, which are known to be inefficient ex post, even though they are necessary, because no, you wouldn't get the knowledge created ex ante if you didn't make R&A remunerative. The only way around that is to fund it publicly, or to have some private sort of Bill Gates type benevolent dictator doing it. So I think the real problem with management of these many tangible assets is that they are sort of ex ante private goods and ex post public goods.
I think certainly Mary fits in with a lot of what Mariana has been telling us. Mariana.
Just a very quick and naive question about the size of how do you call it, human capital. You told that it seems to be a constant in your estimate, that it comes close to 60%, but isn't it the same as saying that the labor share is close to 60% in every country? I mean, isn't it a reflection of the initial assumption?
Yes. Yeah. No, the answer is yes. Because you value, if you go back to the Jorgensen Fermani methodology, which is gold standard, right? You're taking the present value of the currently employed cohort up to the point where the current 15-year-old retires. Right? It's all going to be related to the labor share to begin with.
But how do you sort out different kinds of human capital? So, people talk about digitalisation coming along, lots and lots of conventional middle-class jobs which had conventional human capital associated with them being out the window, but there's this special kind of entrepreneurial human capital, etc. Do you distinguish between countries like China with a kind of their kind of system with human capital in the United States or elsewhere? And how do you see the issue of how the value of human capital will change as the structure of the economy changes with this kind of digitalisation process?
Well, I think even without digitalization, you're going to see that the structure imposed by institutions on top of any of these assets is going to have an enormous impact, right? And that's certainly true of human capital. Of human capital. Well, I've argued that there seems to be something like 20% left over where we don't. We've got reasonable estimates of human capital, natural and produced. If we take theory seriously, present value of future consumption, there's something that seems to be left, and institutions, to my way of thinking, has to be a big part of it. And that's partly why, as I've traveled the world talking about this stuff, there's been a strong response from policymakers saying, yes, this has to be about institutional quality in one way or another, but it's not just that. It's going to be, it's a kind of stock equivalent of TFP that's in there as well, right? It's an accumulation of technical progress that shows up in the residual. As you increase technical efficiency, from the same capital stock, you're getting more and more consumption, right? It's getting buried in there. Which comes back to Cameron's question. I do think there's an important agenda here. I'm relieved that we can whittle it down to 20% left over, and we have to understand that it's a very, very crude estimate, right? Because you can criticize how you took the present value of consumption from now till tomorrow morning. Right? But I'm relieved that we've got it that small. That means that at least with things we can measure, we've made a lot of progress. And now the interesting agenda in many ways is things that are hard to value or things where we don't really have the tools of the data to tease out how much of this is institutional quality, for example, in determining the measured wealth of a nation.
If we were to use, time series forecasting methods to get some error bars around the PV of future consumption, right? Because that could be fairly uncertain. The question that arises is then whether the estimate of institutional capital, which is, you say, effectively the stock equivalent of residual, is significantly different from zero. I know 20% is a big number, but
Sure.
Probably the uncertainty in a future forecast, the forecast of future consumption over 20 is probably a fairly wide range over as well.
Yeah, well, there is an empirical agenda here, and I've started some of that with Susana Ferreira, the working paper at the World Bank. But there's more data we can bring to bear on this issue. All the indicators we have of institutional quality and quality of governance and all these things are sitting there waiting to be exploited. Right? So if we're looking for a research agenda, it's there.
I don't understand something. So maybe I could also, particularly given your paper I had to discuss, your principal result is the present value of consumption is total wealth. So why is it in a total wealth is all the assets properly priced? So how come then the residual in your thing should really be zero? Because any assets, even if there's no intangible capital, it should be just, if there's any intangible capital, it should be priced in the capital, the labor, or whatever your wealth thing. So It's a bit strange discussion.
Marty said it at least twice, and I invite him to say it again. It assumes complete accounting of assets.
Yeah.
We're assuming complete accounts, and this residual has had many names over many decades. I think the best single name for it is that it's a measure of our ignorance.
Exactly. Yeah. That's what I said.
Yes, please.
Well, yes, my name is Trude, and I'm a lawyer, and it's best that you know that. So I was just hearing the discussion that what we're discussing is actually a concept which is meant to be used for making policy decisions, right? And many of the things we discuss or want to protect can also be protected by other measures like environmental law or labor law or diverse kinds of social policies. And perhaps one of the problems here is that there is very bad translation function between those kind of political decisions when you want to weigh them up against a concept of wealth which has deficiency on the cost side. Because all the things we are speaking about when speaking about intangible wealth, you can actually make and pass legislation to protect if you want to. The problem might be that the competition up against a wealth concept, which is very heavy on the on emphasizing the positive sides, creating wealth or creating wealth sooner rather than later, then the balancing kind of thing which the institutions and the policymakers and eventually the politicians have to do will come badly out. So sometimes I think we would be better off if we tried to actually suss out better for what decisions do we need this answer, and is there a other and first best measure which we could test first?
Yes, thank you. I mean, I think we could translate that into a statement about institutions, I think. Right? It's sorry.
I mean, someone mentioned that the labor share has been constant, and yet the wage share in GDP is at a low level.
Generalization. We are at 6:30. We are at 6:30, which means we can continue this debate over nice glasses of red wine, if that's your poison.
There's a coach waiting for us.
Yeah. Thank you. Thanks.